Welcome back, YouTube. So I wanted to point out a few things from Jerome Powell yesterday that I believe is important for us going forward. One of them is a confirmation on something that I thought that would happen over last week and earlier this week. I said that I believe we would have a pivot somewhere around the end of Q1, Q2, because of the data that were coming out and pretty much conflicting with a lot of the older data or even the rate at which they're planning to continue the hikes this year. And it appears that Powell agrees with me. We're going to play some clips here to kind of get some context, but I believe that we are seeing improvement in a lot of areas, and it would only make sense for them to either pause or just kind of adjust the rate. And I believe more likely that they're going to do a pause because Powell has said many times that he doesn't want to missed the mark again, for lack of better words. But he even reiterate that in this clip, which you're going to hear from in a moment. But he'd rather kind of like be on top of it than behind it, or that he doesn't want to have to start hiking again after 6 months or something, because that pretty much is going to put the economy in a huge yo-yo. If he comes out, let's say March, and says we're done, all is well, economy takes off, boom. And November, October, November, it's like, inflation's creeping back up. We actually have to start back hiking again. We're gonna see a huge, it's gonna be, that would make it an incredibly wild year. And he wants to avoid that, obviously. So he just kind of wants to make sure that when they say that they're done, they're actually done. And they don't want to just kind of overdo it. So I'm going to play some clips here from Powell, and then we'll have a discussion here afterwards.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
I'm going to stop it right there. So pretty much you're saying that just kind of touches on the point, saying that, hey, that they're aware of the evidence of disinflation in a lot of different areas, and they're focusing kind of like on core right now, but they are aware that there is evidence of inflation coming down. So that's something that they're keeping track of to make sure that they don't kind of overdo it and kind of forcibly send us into a recession. And just one more point I want to get to.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be. And that's obviously back in December. And the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think, we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data dependent decisions at coming meetings, of course.
So before I continue, I just want to point out that if you see the way he carefully crafted that statement, he was saying that, okay, if they miss the mark to the upside, then, they can move it up, because right now we're looking at their target was around, we're at like 4.75 right now. Their target was 5 to 5.25. So even if we're doing 0.25 rate hikes, we're looking at 2 more if they're going to stick with their original target. Now, what he was saying is, if they have data or it appears that they need to be more aggressive, certainly they'll do that. And what he didn't want to say, which was that they'll make a cut or kind of like retrace their target from that 5.25 to either keeping it where it is right now or at 5. And so that they kind of say, okay, well, we kind of got inflation under control. We don't need to be that aggressive, because if he would have said that, then even like the movements that we've seen today in the market, they would have, they just paled in comparison to the type of upside that you would see from that. Because what that would correlate to is we're either at the bottom or the bottom, or pretty much the bottom is like behind us. So, we'll kind of be roughly like in that bottom area. So all that kind of directly translates into buy now and hurry up and buy, because these are the best prices you're going to get. And then you're just going to get that like boom, that takeoff literally in the market. So that's why he is choosing his words very carefully. But the follow-up question is very important as well. So I'm going to keep playing here.
Quick follow-up. How are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in. And now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that
I'm going to keep playing, and tools for that means if they over tighten or they go too far, tools is printing money. So that's kind of like starting QE back up, because him actually releasing the like he said a moment ago, saying that they're going to release their new numbers or their new kind of adjustments on where they'll kind of like end the BP hikes in March. March is actually our 1-year anniversary of no QE. So this is literally the economy without the steroids, without all the money coming in. But he was saying that if we go into a recession and, because they over tighten, they'll print money again.
In this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services X housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
So yeah, pretty much what he was saying was, in addition to that they'll print money again if they have to, that they don't want to be behind the ball again. So they're literally keeping an eye on core inflation. That's going to be their main focus right now, to make sure that core inflation is coming down. They expect the rental disparities and stuff like that to kind of come down as leases and stuff renew later this year. They expect to get some updated numbers, but ultimately they're focusing on core inflation, and they're not. They're going to adjust those numbers, but they're ultimately keeping a close eye on the data, which is one of the reasons why they did the 0.25 instead of the 0.50, because they see the data coming in and they don't want to overdo it. But they're not going to necessarily declare victory until they have hard evidence that they've in fact had a success. So this is one of the reasons why I believe that we'll see, we won't necessarily do a victory lap in March, April, but we'll see a pause. They're going to say, okay, we're not saying that we're done. We're saying that we're going to pause and see what happens. So I think that's highly likely for March or April. But either way, a pause is going to be taken as the bottom, and it's going to March, April, like he comes out and says that we're going to pause or we're going to keep it here or stop at 5 or something like that, the market is going to take off like you have not seen probably since like 2020, or like when we were having like those bull runs and stuff like that. It's going to be a crazy takeoff. So it's going to keep that in mind. We're going to keep track of the macros here. It's one of the things that I always see on my channel whether I'm covering stocks or crypto, options, whatever. We need the macro to align with the micros. Once you have that alignment, you have a recipe for a bull run. So that is just something that I'm excited about. We're going to keep track of it, obviously, so that we can remain profitable and make the best decisions for our portfolio. Let me know what you think in the comments. If you found anything I had to say had value, like, share, subscribe, and I will see you in the next video.